On July 4th, 2025, President Trump signed the Big Beautiful Bill into law. The White House branded the moment as the largest tax cut in American history, promising that starting next year, almost every paycheck and profit statement in the country will look different. I'm going to walk you through the parts that matter most. By the end of this video, you'll know exactly which breaks land in your pocket, which ones spark new opportunities for your business, and why critics warn that the bill could grow the deficit by more than $3 trillion over the next decade. Let's start where most of us earn our money, wages and tips. Beginning in January of 2026, every dollar you bring home in reported tips or in time and a half overtime pay is exempt from federal income tax. The House Ways and Means Committee estimates that an extra $1,300 a year will go towards tipped workers and about $1,400 for an hourly employee who stays late. The bill also supersizes the standard deduction again, this time $31,500 for married couples filing jointly and half that for single filers, locking in and extending the increases that were about to expire under the 2017 tax laws. The child tax credit also nudges up from $2,000 to $2,200 per child, putting more money back into the hands of roughly 40 million American families. If you're 65 and older, there's a brand new golden years deduction. You simply subtract an additional $6,000 from your taxable income without itemizing, a change supporters say will erase federal income tax entirely for nearly 88% of seniors on Social Security. Drivers get a break too, well, at least drivers of brand new cars that were made in America. Interest you pay on a loan for a new US-built car can now be written off each year, a provision Detroit automakers lobbied hard for years. Health savings accounts get a boost as well. Contribution caps rise by roughly 50%. An extra $4,300 for individual coverage and $8,550 for family coverage, with a $2,000 catch-up allowance if you're over 55 years old. Telehealth visits now qualify as first dollar expenses, and a surviving spouse inherits an HSA completely tax-free, regardless of estate size. Education savers aren't left out either. Parents can use 529 funds for K-12 textbooks, accredited online classes, and for vocational training credentials. Newborns, meanwhile, receive a federally seeded $1,000 Trump investment account that grows tax-deferred until age 18 for college, a first home down payment, or even startup capital for a business. Business owners get an even longer list. The bill restores 100% bonus depreciation for equipment, software, and even the construction of new domestic factories. Section 179 expensing doubles to $2.5 million cap, letting small firms write off a new fleet of trucks or a server farm in the very year that they buy it. Pass-through entities like LLCs or S-corps keep the Section 199A qualified business income deduction permanently. The House wanted to lift the rate to 23% while the Senate left it at 20%, but broadened the phase-in limits so higher-earning service businesses can still claim it. Estate planners take note. The lifetime estate tax exemption vaults to $15 million for individuals and $30 million for couples, and it's indexed annually after 2026. Before we move on to who pays, let's slow down and walk through some concrete, real-world numbers so you can feel what these business and investor breaks actually look like in practice. Picture Steel Wave Fabrication, a 50-person metal shop in Ohio. Management just pulled the trigger on an $850,000 laser cutter that will double their output of custom brackets. Under the bill's permanent 100% bonus depreciation, Steel Wave may deduct the entire $850,000 in 2026 instead of spreading the write-off over 7 years, mirroring the temporary 100% expensing manufacturers have relied on since 2017, but without the scheduled phase-down that would have started next year. At a 24% marginal rate, that single deduction wipes roughly $204,000 off their federal tax bill, enough to cover 2 new welders' salaries for a full year. Now stack Section 179 on top, the new cap jumps from $1.25 million to $2.5 million, and the phase-out threshold rises to $4 million. Suppose Steel Wave also buys a $1.4 million machining center. They can elect Section 179 for the first $1.4 million and still claim bonus depreciation on the laser cutter, all in the same tax year, essentially wiping out every dime of taxable income that the shop might have shown. For companies that live by heavy equipment, the math can be even bigger. A Colorado construction company that spends $3 million on excavators next year could first deduct the maximum $1.25 million under Section 179, then apply 40% bonus depreciation to the remaining $1.75 million, claiming another $700,000 write-off for the first total year deduction of almost $2 million. That combination can flip a profitable year into a loss on paper, carrying unused deductions forward and freeing up cash to bid on that next project. Investors get a taste as well. Think about a private equity group rolling capital into a chain of automated car wash sites. Because most of a car wash, which includes the vacuums, conveyors, recycling pumps, those qualify as personal property. The partnership may carve out a large portion of each building for accelerated or bonus depreciation, offsetting rental income from day one. For cash flow investors, that means real dollars in their pocket, even while the asset's book value drops to near zero on the tax ledger. Paperwork relief shows up in a different way. Under the current IRS rules, you must send a Form 1099 miscellaneous or 1099 NEC to any freelancer you pay $600 or more during the year. The bill lifts that floor to $2,000. Why does that matter? The Tax Foundation estimates businesses and individuals burn through $546 billion a year just complying with tax code. That's roughly 2% of GDP. A GAO study found that retail and hospitality small businesses alone average well over 300 hours a year filling out forms like these. Raising the threshold instantly eliminates tens of millions of slips, reducing printing costs, mailing fees, and the hours your bookkeeper or you personally spend chasing contractor W-9s every January. So whether it's front-loading equipment write-offs or trimming back the blizzard of year-end forms, that the business and investor chapter of this bill isn't just an accounting footnote, it's real cash freed up to hire, reinvest, or simply reclaim a few nights of lost sleep. And with that fresh perspective, now we can turn to the question everyone asks next: who's footing the bill for all of these tax breaks? Of course, every winner has a naysayer. Independent scorekeepers project the bill's $3.8 trillion in tax cuts are offset by only $1.2 trillion in spending reductions, mostly trims to Medicaid and SNAP, leaving $3.3 trillion whole over the next 10 years. So what does this all mean in real dollars? Well, for example, a Denver restaurant server reporting $18,000 in tips will keep roughly $2,000 that used to go to the IRS. A married couple with 2 young kids and a mortgage could save about $2,300 between the bigger standard deduction and a larger child credit. A landscaping firm that buys a $90,000 skid steer next spring writes off the whole cost in 2026, shaving its first-year tax bill to roughly $21,000 at a 24% marginal rate. To capture your share of these tax breaks, make sure you update your W-4 or quarterly estimates this fall so you're not over withholding. Open or boost your health savings account at open enrollment and talk to your CPA before year end if you plan on major equipment purchases. The big beautiful bill is either a middle class windfall or a budget buster, depending on who's talking. But one thing is certain: paychecks, business profits, and estate plans are about to change. If you'd like a breakdown of a specific part of this bill, like the golden years deduction, drop a comment down below, hit subscribe to the channel. As always, thanks for watching and have a great day.